Hey there, this is John Thompson with the TG Loans Mortgage Team. Thanks for tuning in to this Borrow Smart, Repay Smart lesson. Today we're going to be talking about the 30-year versus 15-year mortgage. Of course, every decision made here is individual. Let me go ahead and get started over here. We'll move on to getting rid of me there and move on to the actual lesson itself. All right, so bear with me a quick moment. Here we go. All right, so again, the 30 versus 15. So why do people take a 15 versus a 30-year mortgage? Typically, they want that shorter amortization. They use that amortization to pay off the mortgage quicker. For faster repayment, you have a lower interest rate typically. There's a higher cash flow payment, however, so you typically have a 35 or 40% higher payment because of the faster amortization. And then usually that would achieve long-term interest savings if that is the objective. There are always lots of other objectives to think about as well. So let's look here at a kind of 15-year amortization. You'll see here it's over 15 years. You'll borrow $640,000 in this example, 3.75 interest rate, $197,000 in interest paid. We're not really worrying about expenses or equity. The house value in this example is $800,000. And so the payment is $4,654. All right, so that just shows this black line represents the debt being paid off. Now let's look at a 30-year plan that we might put together for someone. They're going to pay $334,000 in interest payments. The interest rate's higher, 4.125 versus 3.75. However, the cash flow payment is 3102, so you are savings. You had a cash flow difference of 1552, which you'll see down here at this bottom corner. A little bit difficult to see. So that 1552 represents the cash flow savings every month that you would not have put in the mortgage. So remember, there's only three things you can do with money. You can pay off other debt with it, you can blow it, or you can save and invest it. And depending on your situation, we may have a different recommendation. But in this case, we're going to talk about saving and investing it. And if you are in a 5% over long periods of time, which is definitely achievable, you'll see that you have enough money in about 15 years to pay off the mortgage. So these would be pretty much similar in terms of cash flow, assuming someone committed to both those different things. But there's some other risks involved. Let's continue with this kind of idea. So most people don't borrow really for just 15 or 30 years. They tend to borrow, they'll have 4 or 5 homes over their lifetime. They have mortgages for 4 or 5, 6 years. They'll refinance. Different things happen all the time. But a lifetime of borrowing may start at age 30 and might go to 65 or 70. So I'm going to use 35 years in this example. So 35 years in this example, you have the cash flow savings of 1552 is worth $1.65 million over a 35-year period. So you're ahead with your net worth here by $721,000. Pretty impressive. That's a huge difference in thinking about stuff. But to be fair, at the end of 15 years, you would have now not been paying a $4,654 payment. So you could have chosen to actually now start investing that money. I'm not sure many people do that, but that would be the idea to keep this all fair. So we come down here, one more example, 35 years. We got our $4,654 money. Remember, our payment difference is $4,654 and $3,102 with a $1,552 difference. So we still have the $1,552. And of course, to be fair, we put the $3,102 at the end of 30 years when that mortgage is paid off. Now you have the $3,102 in cash flow. So we added that back in for the final 5 years, and let's see what it plays out to. So on this example, you got $1.6 million. Again, that's the $4,654 invested for 15 years. And the 1838 is the $1.838 million is the combination of these savings over here. You're still ahead by $205,000, plus you had all the use and liquidity of that money, and you certainly could have earned potentially more over time or had other opportunities. That being said, there's still lots to think about, right? And so things to kind of consider are borrowing smart, we say, is always about safety, liquidity, and a rate of return. Discipline risk is, will you stick to it? So if you choose to not pay your mortgage more quickly, then you're putting money someplace else, which requires discipline. Can you stick to the plan? Can you put the money aside? Can you not touch it? Can you not blow it? So that's discipline risk. Consider the benefits of liquidity. Life is all about cash flow and having liquidity. When something goes wrong, it may be great if you've been paying down your mortgage, but you need money, and you can't get to that money if it's inside the house. So we do advocate liquidity. Of course, both are great, but if you can have liquidity, that's a good thing. Investing risk is taking risk in the marketplace, earning a certain rate of return, and can you stick to that plan? And markets go up and down. And of course, consider thinking, always think about what you're funding. If you're younger, you still have to fund, education, college, retirement, and so forth. And quite frankly, a lot of people that are a little bit older still have to think about those kinds of things. So be thinking about what other things may be funded. And of course, how long you're going to keep your home. taking a 15-year mortgage and only keeping it for 5 years really does not make a lot of sense. Okay, so again, John Thompson with the DJ Loans team. Let me have a quick moment of your time. All these lessons are wonderful. They're contained in my book, Borrow Smart, Repay Smart. Cal and I are happy to give you a copy anytime for free. Just let us know, and we'll talk to you soon.